Hello everyone, welcome to this new session of FRA for CFA Level 2. Today we'll be going over the last reading of FRA in our curriculum, which is integration of financial statement analysis techniques. Now, this reading, when you just look at the books and you look at the material, it seems like it has a lot of technicalities because there are a lot of lengthy examples given, but those examples are just for your understanding purposes. This reading in particular just marks the end of FRA. So the good thing for you is for students who hated FRA, this is the last time you'll be studying FRA because you don't have FRA at level 3. So this reading pretty much works as a sort of a bringing together of everything that you've studied in FRA across level 1 and 2 and sort of merging it all into one common pool of knowledge. That is what the purpose of this reading is. This reading is not introducing any new concept whatsoever. This is just going to be a recap of everything we've covered in FRA across level 1 and 2 and how all of those things would come together when we actually have to analyze a company's financial statements. That's the sole purpose of this reading. So very basic reading, pretty much theoretical. Any study material that you refer to, just go through the examples as a sort of a study material learning example, not from the purpose of trying to solve the calculations, but more from the understanding purposes, because that's the intention for which those lengthy examples are given in your curriculum and in a lot of other study materials as well. With that out of the way, the best way to cover this reading is to just not refer any other study material for the duration of this video, but do one thing. Pick any company that you like, any company in your country that is reputed, that is a large company which is listed on stock exchange, any company whatsoever. And just imagine a situation that you are sitting in a job interview and this is the job that you want. It will pay you a lot of money. It will give you everything that you need. This is your dream job. And what they have asked you is that to get the job, you need to do an analysis of the company that you selected. So you have a choice, whichever company you like, select that. You have to do a detailed financial analysis of that company. Now, what I want you to do is pause the video for about 10 minutes. And I'm not asking you to do actual financial analysis. No, I'm not even going to ask you to get the financials of that company or anything. If you want, you can do that. Thumbs up from my side. But what I want from your side is pause the video for 10 minutes, take a page, a pen and paper, and start writing down what are the things in the finances of that company that you would like to focus on, so that you are then able to give a proper analysis of the company, whether the company is good, bad, from valuation perspective or from any perspective. So just do one thing, take 10 minutes and just jot down what are the core parameters or items within the financial statements that you would like to focus on. And in those items, if you think there is a particular way in which you would like to analyze them, so normally we just look at information and we look at growth rates, that's fine. But if you think there is something other than just looking at growth of any particular item, so I want to analyze revenue, one way is I just take revenue growth last 5 years and I use that in the future. That is something every financial analyst would do. If you think you have some other way which would be logically more suitable for the company, for any of the items that you list, also write down that. So pause the video for 10 minutes and just jot down the various points that you would try to pick out from the finances that you think will be able to give you an idea whether the company is performing well or not and how you could analyze them. That's it. So go ahead. So I'm assuming that you did pause the video and you did jot down that list. Of course, there is no way for me to know if you actually did it or not, but I'm assuming that all of you did. The good thing is, if you actually jotted down a few points, there's a good chance you noted down elements like we need to analyze the capital of the company, how much equity they have, how much debt they have. You might have noted down that we need to focus on assets, asset quality, depreciation maybe. We will focus on cash flows from different categories, from operating, financing, investing, all of those. We would also focus on some income statement items like operating profits, like revenue, like net profits. If all of this is what you noted down, that this is what you look in a company when you want to decide or when you want to do an analysis of the company, then good job. And from my side, 99% of what this chapter is about is already done. You already know it. If you've written down any of 3 or 4 points that we just talked about, that is pretty much what this chapter is saying. That if you actually have to analyze a company, what are the things you would focus on and how would you further analyze them in much more detail. So now that you have an outlook of what this reading is about, and you also have an idea of how the financial analysis works, let's just go over the material given in this reading. Now, all of this material would make sense because when you have actually jotted down those points and the same points will appear here, you will have a lot more confidence knowing that your thought process was actually on the correct lines. So as such, this reading would not have too much technicality at all. The first topic that they're discussing in this reading is in fact a topic that appeared in level 1 at the introduction part itself. What are the steps of financial statement analysis? So firstly, we need an objective. What is the purpose for which I am analyzing the financial statements of the company? Because according to the purpose, we would change our focus. If I'm doing credit rating, I'm more focused on the leverage and debt side of things for the company. But if I'm doing valuation, I might be more interested in cash flows for equity or maybe net income to see the profitability of the company. So depending upon what the purpose of analysis is, I will then adjust my entire process accordingly. Then we gather the data according to our objective. We process the data. Process is basically running it through our financial models, calculating ratios, everything. Then we have an interpretation. So all ratios are calculated in step 3. All the parameters, valuations, everything is calculated and estimated in step 3. Fourth is basically we looking at those ratios and those calculated outputs and then making a decision on the basis of the same. So just calculation of ratios is part of 3, but actually taking a decision and interpreting those ratios, what they mean for the company, that is part of step 4. After step 4, we look at reporting. So basically, whatever my final interpretation is, I will report my analysis in a proper documented form to whoever was interested in that. Sometimes it could be general public, sometimes it could be a specific client. And then lastly, you had a follow-up stage where because financial statements are very dynamic, every year you have new financials, you have new information released to the public. For listed company, often the information is released on a quarterly basis. So every time you have new information available, that new information might cause a change in your previously reported results. If there is a change, your job is that whenever you get a new information, you would update your entire analysis. You will go along with all of these steps one more time to incorporate that new information. And if there is a change in results, you would report a updated version of your previous results. So I hope the basics are clear. This is just a revision. Now, let's look at what are the various elements that this chapter is focusing on. So, all of the elements that you just noted down in the 10 minutes that you took, all of those are correct. Let me tell you right away, in the real world, the analysis is always subjective. The analysis that you might do might differ from the analysis of another student. So, as such, there is no wrong answer. If you think for a company some parameter is important and you can justify that, then yes, it is important. So there is no hard and fast rule that only few elements are important, others are to be ignored. No. In this particular reading, we'll be focused on just 4 or 5 core elements that we often have as part of our financial analysis pretty much all the time. So we'll just look at those few. Let's have a look at them. So the syllabus is identifying these 6 core areas of focus. And these 6 topics or these 6 focus areas is all we have to discuss in this reading. So this marks the completion of FRA and this reading as well. Let's have a look at them one by one in detail. The first focus area is the earnings of the company, and earnings are very important because at the end of the day, any company that is operating, it is operating with the intention of earning money, earning profits. So as such, earnings or analysis of net income, analysis of net profit becomes very important for me because it helps me judge whether the company is actually performing good or not. income statement as a statement is an indication of financial performance of the company. So analysis of earnings tells me whether the company is actually performing up to the mark or not. And over here, our purpose is not just to look at some sort of growth trend or just to have a basic idea whether the company is earning profits or not, just focus on margins. No. Rather, our intention is to not only look at growth side of things, but also what is causing that growth. Because if revenues are increasing, but those are increasing due to non-operating reasons, then that's not good enough for me. I don't think that is sustainable. So whenever we analyze earnings, our focus is going to be on trying to get something that would be sustainable in the long run for the company. So for the earnings, one of the main parameters that we use is called DuPont analysis, which used to break down my return on equity. Now, return on equity is a very good parameter of knowing whether the company is performing good or not, because at the end of the day, that is the return that any owner of the company is getting. Return on equity is the return for the owners of the company. And as such, in DuPont analysis, the earnings were broken down into 5 parts. We had tax burden, we had interest burden, then we had operating profit margin, we had asset turnover, and we had financial leverage. And as such, this 5-part classification of DuPont analysis is very useful for us because it helps us to look at what exactly could be causing an increase in net income. In general, if ROE is increasing, normally equity of a company remains stable unless there is a share repurchase, which is a rare transaction. It doesn't happen every year. Every year, companies are not repurchasing their shares. So as such, change in shares or change in equity is not going to happen on a year-to-year basis due to transactions in the nature of issue of new shares or repurchase of old shares. That is not a regular transaction. But income or the net income, that is a regular occurrence. Every year, the operations will generate some income. So in general, if ROE is being impacted, we believe that it has to be one of these factors that is causing the impact in ROE. And knowing which factor is causing that impact will help us decide if the growth of my net income, is it sustainable in the long run, or is it happening just because of some minor change that might have happened in the business environment. For example, government is of the opinion that they want to reduce taxes gradually. And I know that tax burden is a very big burden for my company. This is one of the reasons why my net income is normally low. But in the future, if government is planning to reduce taxes, that would be beneficial for my company because that would mean that the burden that they have for tax, this would reduce. And a lower tax burden could further increase my earnings. So as such, knowing these bifurcations and analyzing them would give us a breakdown of not just what earnings are, but what are the factors influencing that earning. So our analysis is not just going to be focused on what profits are, how much they are growing year on year. Sure, that is important. But we also want to know what is causing that growth. We are not just concerned with numerical trends, we are also concerned with financial logic behind those trends. So this is one of the parameters that we use to understand further what could be causing the change in my earnings and my performance of the company. Next up, we have a discussion about asset base. Assets in total are a very big portion of my company, and as such, analysis of asset base is very crucial because assets represent the sort of economic resources that I have, which I will use in my core operations, and then I will be able to generate some benefit for the company. So my entire operations are dependent on the assets that I have. If a company wants to make cars, they need some machines, they need some factory assets which will help them make cars. If they have no assets, they will have a very tough job of actually making a car. So as such, having good quality assets is very important, and asset base has to be analyzed with that perspective only, that if I'm looking at a company and I want to know how good they are capable of performing, not just right now, but also in the future. Analysis of assets is very important because these are the resources that will be used to generate benefit in the future. Now, within the asset base, we often analyze the various elements of assets. So, in the financials itself, the company normally just reports tangible assets or property, plant, equipment, and intangible assets. But in notes to accounts, they give further details as to what are the different assets which are categorized as property, plant, equipment. You can have details of machine, land, building, vehicles, or any other asset that the company can have. Sometimes companies even have private jets or private helicopters for their CEOs or senior management. Those are also assets of the company. So all of the details about what are the assets, you will find them in the notes to accounts. And then we analyze how these assets are growing from one year to the next. For example, if a company has 60% of its assets, 60% of the worth of assets is just private jets for its senior managers, and this is a company that, let's say, makes cars. These 60% of the assets, which are just private jets that they have for traveling for their senior managers or CEO, this is not going to be useful for the actual production, actual operation part of things. It might be useful in a corporate sense, but they are not going to impact operations. So not only are we focused on what the asset value of the company is, how many assets they have, but we also want to know whether these assets would help enhancing the operations in the future, or whether most of these assets are of the nature that they are more corporate and administrative and less so for the operational aspects of the company. So that gives us a very good idea about what the future benefits of the company would be. If the company has really good asset base, in the future they'll be able to increase their scale of operations. But if the assets are more or less of non-operating nature, then increasing the scale of operations in the future would be more challenging for the company. Along with that, we also analyze within asset base the impact of depreciation. So sometimes within industry, different companies use different parameters for depreciation. Some might have higher estimation of life, some might have lower estimation of useful life of the asset. So as such, these comparisons also become relevant, because if the entire industry normally takes an asset and thinks that this asset should have a useful life of 10 years, and my company is taking an assumption that this asset has a life of 20 years, then that is not a realistic assumption, because if the entire industry is following one particular trend, we would expect our company to also follow that. And if our company is following something different, of course, it is correct as per accounting standards. But the issue is not whether it's correct as per accounting standards or not. The issue is how it impacts the performance capability of my company. Because in general, if the entire industry thinks that the asset is usable for 10 years, after 10 years, there is a good chance this asset might not be usable. But if my company and the management thinks that this asset can be used for 20 years, there is a chance that in the next 10 years, in the last half of 10 years, they might run into more asset related problems and more issues with regards to maintenance and upkeep of the asset. So as such, we often compare not just assets, but all the charges on the asset as well: impairment, depreciation, all of these things would be analyzed on different types of assets to give us an idea of what actually the resource pool of the company is capable of in the long run. Next up, we take our focus to capital structure of the company. Capital structure is fairly important. It's the composition of where exactly is the company raising money from. Is it debt? Is it equity? Within equity, is it common shares or preference shares? You can have different possible sources of money. And understanding what the capital structure of the company is very important, because if, imagine a situation, a company already has a lot of debt. Debt has very low cost as compared to equity, and the company already has a lot of debt. They will end up having a little bit trouble on raising more debt. Whereas if I compare it with another company which is performing very good, they have pretty much 100% equity. If they want to take a loan, they will be able to reduce their cost of capital, because cost of debt would be lower. Debt comes at a lower cost. And they will also readily get that loan because of their better operational and capital structure history. So as such, the options in terms of financing that the company will have available in the future, those are impacted by what their capital structure trend has been in the past. Often companies would make a public statement as well that we want to take our company in a zero debt situation over the next 5 years or 10 years, that we want to get rid of debt from our company. So all of these parameters would also help us to judge that if I'm looking at future benefits or future profits, future cash flows of a company, and I'm doing some sort of discounting using current cost of capital, that would not be correct, because if in the next 5 years the company expects to gradually reduce the amount of debt, I should use some sort of cost of capital that indicates that future situation that the company would be in. So as such, analyzing capital structure becomes important, because in all sort of valuation techniques that we use some sort of discount rate, and that discount rate is nothing but an implication of how capital structure would affect the company. So knowing capital structure and any proposed changes in these things would be very important for our analysis. Now, any proposed changes due to future expansions or any other business plans that might have, you would often get information for those in management discussion and analysis. So we are not just focused on financial statement side of things, but also additional information we could get at the company reports, which could be useful in our analysis of what the future holds for our company. Next up, let's discuss cash flow analysis first, because capital allocation and market value decomposition is something we'll discuss together. They are both linked till some extent. So cash flow analysis is primarily based on how much cash a company is able to generate on a regular basis. The reason why cash flow analysis is very important is because if you look at entire CFA curriculum that you have studied across level 1 and 2, aside from FRA, whenever we have to take decisions, we take decisions on the basis of cash flows, whether it is capital budgeting decisions, whether it's valuation for equity, valuation for fixed income, valuation for derivatives, anything is based on what cash flows a company or a financial asset might have. So as such, because in financial world, all of our decisions are based on cash, cash flow analysis becomes very important. And cash flow analysis is not just looking at what cash flow from operations are and what their growth is, what is the cash flow from investing, their growth, and all of those things. Yes, those are the basic analysis that we can do. But rather, we often look at cash flows and compare them with our earnings. This is done by way of analyzing what is called accruals. Accruals can be judged in various ways. So we look at accruals. Basically, accruals is the difference that a company has in terms of their net income compared with that of cash flow from operations. So basically, how much of the company's financial statements are impacted due to items that are there simply due to the accrual assumption, which means if accrual assumption was not there, how much of the balance sheet, income statement, financial statements in general would be impacted. So transactions which are just there due to accrual assumption, those are what we try to figure out with accruals. Now, this is not a hard and fast rule, the equations that we're going to study, and often at times these might not be the most accurate assumptions. So for balance sheet, if I want to know how much of my balance sheet values are impacted due to just accrual adjustments, normally the approach is fairly simple. We look at net operating assets ending minus net operating assets begin. This is going to give me an idea of what the assets are at the end of the year versus what the net assets are at the beginning of the year. Now, I know if you buy an asset that is a cash item, that would impact this one also. And as such, this is not a 100% accurate way of estimating accrual. But think for a moment about what is the main accrual adjustment that we do for assets. It's depreciation. So if an asset's value is changing over the year purely due to depreciation, depreciation is nothing but an allocation of cost of asset over its useful life, and it is done due to the accrual assumption. If we didn't have accrual assumption, we would not need depreciation. So any element like depreciation, like impairment, that ends up impacting the value of assets. So if an assets are changing just due to that, that change is nothing but an accrual item, that it would not be something that would affect my cash flows. So yes, if you actually purchase or sell an asset, this calculation, this would change, but that would not be due to accruals. That is why this equation is not 100% accurate, but this is a starting point to help us judge how much of an impact could be due to just accrual assumption related transactions. Now, just like we have for balance sheet a calculation, we also have one for cash flow statement. Cash flow statement is slightly more logical. It says net income minus cash flow from operations and cash flow from investing. Cash flow from financing is not here due to one very simple reason. If a company issues more shares or if they take more loan, that would have cash inflow, but we don't consider that to be of an operational nature. We don't consider it to be of a recurring nature. So we are just taking recurring values where we have net income, which is the profit from all the operations of the company, minus how much cash flow from operations and investing a company has. Basically, net income minus all the cash flows, that would give you just the value of items which are impacting net income, but they are not impacting cash because they are of non-cash nature. So this would give you an item of this will give you an idea of what the net impact of all non-cash items is in terms of my income statement. Now, both of these are outright calculations of what the dollar value of accruals is. We can also have some sort of a percentage based calculation where what we do is we divide both of these elements with average net operating assets. So if I'm comparing accruals of different size companies within an industry, then instead of comparing outright dollar value of accruals, comparing the ratio would be more sensible because this is a ratio that would give you some sort of a percentage related value. So this facilitates comparison. The average NOA is simply ending plus beginning divided by 2. So no complications there. Once again, these ratios, these are not 100% accurate because here also in net income, we do have interest. Interest paid on loan is part of net income, but it is not being adjusted in CFO or CFI if a company reports interest paid as a financing item. Because at times in IFRS, the company has an option whether they want to report interest paid as financing or as operating. So in US GAAP, of course, that interest is also taken care of because we have cash flow from operations. But in IFRS, it would not be taken care of. So these equations are not 100% accurate right away. These are more for giving you a reference of how we might estimate the impact of accruals. Aside from this specific to cash flow analysis, you also have something known as cash generated from operations. So instead of looking at cash flow from operations, we look at cash generated in operations. And over there, we start with EBIT, which is our operating profit. And we make adjustments in EBIT itself to convert it into cash components. So we add non-cash charges, and we subtract increase in working capital. So similar to the calculations we did using indirect method at level 1 for cash flow from operations, the only difference is this time I'm not concerned with total cash flow. I'm just concerned with cash that is being created out of operations, not total operating cash flows, but just the one that is created during the year. So operating profit is being adjusted instead of net income. So that completes our discussion for cash flow analysis as well. Lastly, we have capital allocation and market value decomposition. The reason why these both are related is because both of these will exist only in case of companies that actually operate on a very large scale, which operate in multiple industries, might even have multiple subsidiary companies. For those, this is going to be relevant. Capital allocation, if you remember in corporate finance, we had something called capital rationing, that at times the resources we have are limited. So a company will have to decide where exactly do they allocate those resources. Capital allocation is exactly that. Any company has limited set of opportunities, they have limited set of resources, and as a result they have to allocate those resources over opportunities in a way that would be most beneficial for them. So as such, for us, it is important to look at the company's capital allocation, that if a company is operating in 5 different industries, how exactly does it allocate money? That is it preferring one industry over the other, or is it evenly allocating to all the industries? This would be important because if out of 100% investments that a company is making during the year, 80% are in one sector, then our entire analysis of future earning potential of the company would change. Because if the company is betting 80% of its money on one particular division, on one particular segment, that segment's success would now decide the future earning potential of the company. So capital allocation is more of in the line of giving us an idea where exactly is the company allocating its capital, and that allocation would give us more of an idea as to what should be our focus points for future potential of the company. The companies might have different sectors in which they operate. For example, in India, Reliance is a very big company. They operate in telecom, they operate in entertainment, oil and gas exploration. They also have refinery operations. They also work in electronics. So a lot of different divisions. And as such, in each of their annual report, they give details that how much of our business and revenue is coming from one segment, from the other segment. So segment related analysis would give us a good idea of where the capital is mostly being invested and which sectors are very key components of the company as a whole. And then you have market value decomposition, which is specific to a case where there are a lot of subsidiaries. So capital allocation can be there if the business has different segments. But different segments is not the same thing as having different subsidiaries. In case a company has different subsidiaries, the concept of market value decomposition simply states that we should try to decompose the value of a company on a standalone basis. Normally, if you value a parent company, you value it on the basis of consolidated financials, and the value of the parent company is inclusive of value of all the subsidiaries. It is all inclusive value. But in reality, sometimes it would be more beneficial for us to look at the value of parent company just on a standalone basis. So what we do is we often remove the value of subsidiaries or the portion of value of subsidiary that the parent owns, and then whatever value is left, that is the value of parent by itself. The reason why that value is important is because the parent company also has its operations. If the value of parent company after removing the value of subsidiaries is not matching the value we would have gotten if we looked at just operations of standalone company, then it gives us some sort of disparity that we can use for our investment strategy. Let's say there is a company that has main operations of manufacturing cars, but they also have subsidiaries operating in different sectors. Let's say smaller car parts manufacturing companies. The total value of the parent company is, let's say, $100 on a per share basis. And the share of that $100 which is impacted by subsidiaries, let's say that is $30. So if I remove that $30 on a standalone basis, the parent company should be worth $70. Their shares should be worth $70. However, when I just look at parent company's own standalone operations, that gives me an indication that their value should only be about $50, which means their share price might be overvalued slightly because their standalone operations do not justify their decomposed market value. Decomposed market value simply means value of a parent company after removing the impact of value of subsidiaries that they hold. So often we can have that analysis also, which gives us an idea what the value of the company by itself should be, and that could be further used in other valuation analysis. So I hope all of the discussion made sense. Once again, in your curriculum and study materials, you have examples given for these. Examples are just for reading purposes, for understanding purposes. Don't get confused because they don't have any new calculations as such. That also brings us to the end of FRA for level 2 and also for your entire CFA. You don't have FRA at level 3. As always, if you have any doubts, queries, you can always reach out to me, and I hope you found the session fun and informative. That's it from my side. I'll see you in the next one. Goodbye.